Hey guys, what is up? Welcome to my channel. So you want to invest into StashAway but you do not want to take up too much risk, which is why you are here today looking at this 22% risk index portfolio. Well, that is exactly why I'm here today, because I'm going to break down that 22% risk index portfolio for you so that you know what you're investing your hard-earned money into. So just for your info, last week I covered the 36% risk index portfolio, which is largely similar to the 22% risk index portfolio, save for a different points. Allow me to show you just a quick one. On the left hand side, we have the 22% risk index portfolio, and on the right hand side, we have the 36% risk index portfolio. As you can see, the only difference here is 1. The asset allocation weightage. 2. We have 2 additional asset classes on the 22% risk index portfolio, which are the fixed income as well as the government bonds. And number 3, there's no real estate assets in the 22% portfolio. So for the sake of the first time viewers, I will cover the same asset classes such as the equities in the US, the commodities, international equities, and cash. And then I will follow through with a more emphasis on the fixed income as well as the government bonds. So let's quickly look at the equity sectors in the US. There are 3 ETFs under this class. The first one is the iShares Core S&P Small Cap ETF, which mainly invests into small market cap US companies such as Momenta Pharmaceuticals, Stamps.com, Simpson Manufacturing, and etc. And the market cap usually ranges between $300 million to $2 billion US. The second ETF under this asset class is the Healthcare Select Sector SPDR Fund, which invests into the pharmaceuticals, biotechnology, and healthcare technology industries such as Johnson & Johnson, United Health Group, Merck & Co., as well as Pfizer. The third ETF under this sector is the Consumer Discretionary Select Sector SPDR Fund, which invests into consumer sectors such as retail, hotels, restaurants, luxury goods, and etc. The second asset class under this portfolio is the commodities, which has 20% weightage. The SPDR Gold Trust invests into gold. Gold to me is just another form of asset which does not create any value. It just protects the investors in a different form of asset. The third asset class is the international equities with a weightage of 11%. The Crane Shares CSI China Internet ETF invest into Chinese internet companies such as Alibaba Group, Tencent Holdings, Meituan Dianping, JD.com, and many other more internet giants in China. And lastly, we have cash, which is denominated in the US dollars, which protects your ringgit and Sing dollars for depreciation against the US dollars. So that is all for the 4 similar asset classes that both portfolios share. If you want more detailed explanations, feel free to check this video and I'll link it on the top right corner or the description box down below. So now to the highlight of this video. Let's start by looking at fixed income with a weightage of 17%. The Vanguard Total International Bond ETF is basically the ETF that tracks all the non-US dollar denominated investment grade bonds in the world with an expense ratio of 0.08% per annum, which is very low. So just a quick crash course on what are bonds. Bond is a kind of fixed income instrument which is usually issued by corporates or government, almost similar to a loan. And every bond will have its own credit rating, which are rated by rating agencies such as S&P, Moody's, and Fitch. From this chart, you can see that anything above the red line is considered investment grade. So this rating depends on the quality of the bond issuer, which are the corporates or governments. Hence, they will have different bond yield. This bond yield or interest rate in loans will indirectly represent the return of investment, which is what investors like me and you are investing for. So a higher quality investment grade bond will usually fetch lower risk and hence its bond yield will be lower. Okay? So back to the ETF itself, let's look at its performance. It is up 2.21% for the past 1 year, up 5.16% for the past 3 years, and up 4.37% for the past 5 years. All in all, pretty standard for investment grade bonds, which usually ranges around 4 to 6%. So now's the question, how is this different from the individual stocks that we used to know? From this pyramid, it shows the higher you go, the higher risk there is. So bonds are usually at the bottom of this pyramid, representing the lower risk investment vehicle, whereas shares or stocks are usually at the top of the pyramid, representing higher risk. In terms of their market allocation, the top 5 markets in this ETF are allocated in Japan, France, Germany, United Kingdom, and Italy, all of which are advanced economies. So we can expect more investment grade bonds from this ETF. So just a quick fun tip for you. When people talk about countries having trillions and trillions of debt, they are actually referring to bonds issued by the government, not loans. Alright, let's move on. We look at the next asset class, which is the government bonds with a 9% weightage. The iShares JP Morgan US dollar emerging markets bond ETF tracks an index consisting of US dollar denominated emerging market bonds with an expense ratio of 0.39% per annum. It tracks bonds from more than 30 emerging market countries, with the largest ones from Mexico at 5.36%, Indonesia at 5.12%, Saudi Arabia at 4.73%, and etc. In terms of credit quality, the amount of BBB rated bonds stands the most at 35.89%, which is expected as the emerging markets usually comes at higher risk and more uncertainties, which is why their credit ratings are usually not as good as developed countries. In terms of their performance, it is up 1.99% for the past 1 year, up 3.2% for the past 3 years, up 5.77% for the past 5 years, and up 4.76% for the past 10 years. All in all, it seems pretty average, but it could be better with more BBB rated bonds. Okay, that pretty much sums up today's video. The usual disclaimer applies, and I am by no means advising you to invest into this portfolio. I hope this video gives you a better insight into this 22% risk index portfolio, and if it did, help me hit that like and subscribe button down below, and it helps me so much. Feel free to use the referral link down below and you will enjoy free management fee waiver for up to 6 months. Thank you very much for watching, and as usual, I will see you in the next one.